Aniruddha Sarkar is our guest on the show today, and Aniruddha is coming here after a long time. So clearly, he's been busy making money for his clients. You've been in the quest of outperformance or alpha, right, Aniruddha? How have the last few months been for you? Challenging or okay? You navigated, kind of comfortably, because the clamor for a massive correction is getting louder. But people, are they raising cash levels? Have you raised your cash levels? How are you approaching this?
Yeah, hi Ajay. So thanks for having me on your show. So obviously the last couple of months, definitely it's not been a very easy walk for all of us in the market. And typically what happens is, when the markets are volatile, that is when the real test of a portfolio happens. So thankfully in the last couple of months, in the midst of elections, budget, whatever is happening in Bangladesh, what is happening in the rest of the world, in Middle East, I think in the midst of all this noise, thankfully our portfolios have done well. And I think that is because we have been trying to focus on very, very few sectors, looking at companies within those sectors where earnings are supporting the valuations. Because I think one concern in the market, which even I have, is valuations have definitely become very rich across the board. So it's become very important that you don't get into companies where there's a big froth. Look for companies where there's a mismatch of valuation and underlying the value. Now, within that, I would say the easy part of making money has gone. Like last 24 to 36 months, all of us have made money in the market. Some have made more, some have made less. But I think the easy part of making money has gone. 6, 8 months back, practically 60% of the small caps were outperforming the small cap index. That has now come down to around 25% to 30%, which means the breadth of the market has gone down, which means that it has become more difficult now to look for the money making ideas. So thankfully, we have been able to, be there in the market and participate. When talking about cash, I've not aggressively raised cash, but yes, I would say keeping 4-5% cash is what I'm doing. On a more upper side, I would recommend investors to keep more than 8 to 10% cash because I think I don't see any major correction in the market because if you look at where Indian markets have been in the last couple of months, in the midst of all the events which has been happening in the world, India continues to be a massive outperforming market. We saw how the Southeast Asia markets performed, how even the US markets performed. In midst of that, I think we have been very, very kind of the mature market, and all thanks to the domestic investors, I think we have been single-handedly holding the markets, and I think that is giving a lot of confidence to even the global investors that Indian markets have been very kind of the resilient in the face of whatever is happening.
That's a very differentiated call. I would say that you don't see any major correction setting in the market in the near term, because most on the street are expecting a pretty decent correction, but it's not happening, of course. Let's talk about some of the ideas that you like. Real estate. Mumbai based real estate players, you have some in your portfolio like Ajmera Realty. We won't talk on the stock particular, but I want to talk about where in the realty cycle are we, and some of these metro centric guys, because there's equal amount of supply which is actually coming in. Do you see all of that getting absorbed?
Yeah, so I would say that, if I look at my optimism level in the real estate sector, definitely it has declined in the last couple of months. If I look at where I was optimistic, say 4, 5 months back, and where I'm optimistic today, definitely that optimism has come off. Part of it is because of the oversupply which is there in the market. A part of it is also to do with what we had in the budget with regard to the indexation benefit going off. And that I feel definitely will make the real estate as an asset class equally comparable to equity as an asset class for any new investor who's putting in money into the market or into the real estate. So I'm a bit less optimistic on the real estate sector as of now. And as you rightly mentioned, I think, the optimism has come off as of now. Within that, I have exposure into a couple of the small cap real estate companies, particularly because of the valuation comfort which is there. The sector has underperformed for the last 6 months. I think it's a time correction with some amount of price correction which we have seen. But I think the valuations have become very attractive. And if I look at the NAV of most of these real estate companies, I think it's quoting at a good discount to the peak multiple of the NAV which it used to happen.
Surprising, I see some of the holding companies, some south based conglomerates holding companies also in your portfolio. I want to understand your investment thesis behind in some of them?
See, with regard to the holding companies, I think, like historically, we have not been very bullish on the holding companies because I think, this whole concept of the holdco discount is something which used to always continue. But I think so without taking any names, so we have been investing into some holding company, and I think there's good value unlocking which is possible in the business because apart from the listed holding company which it has, which is holding company into a listed company, there are two other businesses in the unlisted part which are also doing well. One is in the real estate and one is into the NBFC space. So our view is that it's a good value. So as I mentioned in my initial comments that it's very difficult to look for ideas in this market, and it's become very important that we look for where is the misprice between the value and the underlying value, the value which the market is giving and the underlying value. And within that, I felt, this holding company is a very, very good, safe bet, management quality, impeccable, good, the core business, which is the holding company that is doing very well. And apart from that, the two unlisted businesses, one being in the real estate and one being into the financial services, both are doing exceptionally well. So it becomes kind of a good idea with regard to our investment over there.
What are your thoughts on some of the private banks, the larger private banks? You have two of the largest private banks in your portfolios, but unfortunately they've not done very well in the last 1 or 2 years, maybe overowned by FIs who are in sell mode, but the numbers have been, at least one of them have been improving a whole lot. This must be a bit of a drag on your overall portfolio so far. What's your thoughts there?
So I've been underweight on the banks overall. If I look at my last, 24 to 36 months, overall, I've been underweight on the banks. And to some extent, that has helped me also for most of this period. If I look at the last 8 quarters, out of 8 quarters, I think 6 quarters being underweight on the banks has helped. So I would say as of today, we are definitely not very bullish. I'm not very bullish on the banks because I think you will see the NIM contraction continuing. And valuation wise, they are very attractive. There's no question on that because, they have come off a lot from the peak multiples. Valuations wise, it has become very attractive. But I would say you are not going to see a multiple expansion from where it is today. You're going to see a earnings led growth in the price. So you'll see more of a, if you're getting a, 17, 18, 19% kind of an earnings growth, you'll see these companies giving you that type of a return. So NIM contraction is also to be something which market will keep on, getting worried from time to time, because I think if I look at the deposit ratio along with the lending ratio, I think RBI has been focusing all the more for the private banks that, you have to improve the lending deposit ratio, and that is going to keep a pressure on the lending for some time. So NIM contraction is again something which is going to hurt them.
Interesting. I can see some of your holdings in this capital goods space are doing very well in terms of they may have gone through a bit of a correction from the top. I'm talking about ABB, but the quality of numbers are very good, especially outlook, and not only for ABB, even Cummins came out. I want to understand the capital good top premier end, the premium end of top. They were being questions on valuations, but the quality of earnings which are coming in commentary, do you think the case to own them from here also next 2-3 years is strong?
Absolutely, Ajay. So I would say that, in fact, 18 to 24 months back when we got into some of these capital good names, we used to hear I would say the same kind of discussion that, they are expensive. They should trade at 50, 60p. Now they trade at 80, 100p. But I would say that, we have to look from a 36-month horizon that where can FY27 multiples look like. And if I look at the type of growth these companies are giving at this base, I think it is unmatched in the history of these companies. And if one has to play the whole India manufacturing, domestic manufacturing, India capex cycle, I think these are some of the names you have to definitely be invested in. You have to definitely pay a slightly premium. It's not that they are cheap. But yes, any miss in the earnings in any year, definitely it will have kind of an impact on these companies. But I would say as of now, there is no visibility that they are going to miss on the numbers. Consistently, they have been doing well every quarter, and I think any short-term correction in these companies because of panic in the market would be good buying opportunities.
Excellent. All right, Aniruddha, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you.
That was Quest Investment Advisors Aniruddha Sarkar joining us on the show.
If you like this video, then like, share and subscribe to ET Now.